the European Central Bank has taken a firm stance against euro stablecoins, rejecting several proposals designed to promote their development. During a recent meeting with European Union finance ministers, the ECB expressed concerns that these stablecoins could undermine financial stability and disrupt monetary policy. This decision marks a shift in tone, as the ECB has moved from cautious observation to outright resistance. The bank is particularly worried about the potential for a large-scale transfer of bank deposits into private stablecoins, which could weaken the traditional banking system and reduce the ECB's control over monetary conditions. The ECB's position is clear. It does not want to become a lender of last resort for stablecoin issuers, a role it believes should remain reserved for traditional banks and public institutions. The push for euro stablecoins comes amid growing competition from dollar-backed stablecoins like USDT and USDC, which dominate the global market and are reshaping digital payment systems. France and other EU members had advocated for the development of euro stablecoins to boost Europe's presence in the digital currency arena. However, the ECB, led by President Christine Lagarde, has resisted these efforts, arguing that such assets could create systemic risks. The bank's concerns are not theoretical. A shift in consumer and institutional behavior toward private stablecoins could lead to liquidity crises, especially if confidence in the reserves backing these coins were to wane. The ECB also fears that the rise of euro stablecoins could increase the cost of financing for European banks and weaken the transmission of monetary policy decisions. In a world where digital payments are rapidly evolving, the ECB is choosing. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Caution over innovation. The bank's rejection of proposals from the Bruegel think tank highlights its skepticism about the viability of euro stablecoins as a safe and stable alternative to traditional currency. The ECB's position reflects a broader tension within the EU, the desire to compete in the global digital finance space versus the need to maintain financial stability and control. While some member states see euro stablecoins as a way to challenge the dominance of dollar-based assets, the ECB remains focused on protecting the integrity of the European banking system. The ECB's stance is not without precedent. Central banks around the world are grappling with how to regulate stablecoins and other digital assets without stifling innovation. However, the ECB's approach suggests a preference for maintaining the status quo, at least for now. The bank's concerns about a potential liquidity crisis are particularly relevant in light of recent events in the financial sector, where sudden shifts in asset demand have led to instability. The ECB is also wary of the possibility that private stablecoins could become too big to fail, forcing the central bank to take on responsibilities it is not prepared to assume. The next signal to watch is whether the European Union will push back against the ECB's position, or if it will accept the central bank's warnings as a legitimate reason to delay the development of euro stablecoins. The outcome of this debate will have significant implications for the future of digital payments in Europe and the role of central banks in regulating private financial assets. The mechanism at play involves the structure of stablecoins themselves, assets that are typically pegged to a fiat currency like the euro or the dollar. If euro stablecoins were to gain widespread adoption, they could function as an alternative to bank deposits, effectively bypassing traditional financial intermediaries. This could lead to a scenario where individuals and businesses hold their money in stablecoins rather than in bank accounts, reducing the flow of funds into the banking system and, in turn, limiting the ECB's ability to influence interest rates and credit conditions. The stakes are high because the ECB's monetary policy is a key tool for managing inflation and economic growth across the Eurozone. If stablecoins begin to absorb a significant portion of bank deposits, the central bank's ability to steer the economy could be compromised. Additionally, if the reserves backing euro stablecoins are not fully transparent or secure, most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Loss of confidence could trigger a rapid withdrawal of funds, leading to a liquidity crisis. The ECB is also concerned about the broader implications of private entities issuing digital currencies that are effectively competing with central bank-issued money. If stablecoin issuers gain too much influence, they could exert pressure on monetary policy and financial regulation, potentially leading to a situation where private interests dictate the direction of the financial system. The next signal to watch is whether the European Union will push back against the ECB's position, or if it will accept the central bank's warnings as a legitimate reason to delay the development of euro stablecoins. The outcome of this debate will have significant implications for the future of digital payments in Europe and the role of central banks in regulating private financial assets.